Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the endless stream of corporate jargon so we can all be a little bit richer and a lot less confused. Today we've got a peek behind the curtain at the First Eagle Private Credit Fund, and let's just say they've been busy bees. These guys are a private credit fund, meaning they lend money to companies, usually those that might have a harder time getting loans from traditional banks. Think of them as the venture capitalists of the debt world. This filing drops some interesting details about their recent sales, their fund performance, and what their investment portfolio looks like. So they've sold some shares, unregistered shares, to a special vehicle set up just to hold more of their fund's shares. On the 1st of July, they sold 279 of these Class I shares for a cool 6,700. This is a common way for funds to raise capital quickly without all the registration headaches of a big public offering. It just means these shares aren't publicly traded on an exchange. Now let's get to the good stuff, the distributions, the money they're paying out to their investors. On July 24th, they declared these distributions for the month. For Class I shares, they're paying out 21 cents per share with no fees attached. For Class D shares, it's also 21 cents gross, but there's a small shareholder servicing fee of half a cent, bringing the net distribution down to 25 cents. These payments are expected on August 28th, either in cash or reinvested back into more shares for those in the fund's reinvestment plan. It's always good to see cash flow being returned to investors. But what's the value of those shares? As of June 30th, the net asset value or NIV per share for both Class I and Class D shares was $24.00. That's the underlying worth of each share. That's the underlying worth of each share based on the value of the fund's investments. And speaking of value, let's look at how much they're paying out relative to that share value. For Class I shares, the annualized distribution rate is 10.9%. That means if this rate continues throughout the year, they'd be paying out a little over 10% of the share's value in distributions over 12 months. For Class D shares, it's a bit lower at 10.24%. Now they make a crucial point here. Distributions are not guaranteed and can be paid from sources other than cash flow, like selling assets or borrowing money. This is super important because it means a high distribution rate doesn't always mean the company is making a ton of profit. Sometimes they're just returning your own money or money they borrowed. They also mention these distributions can be funded by temporary fee waivers from the investment advisor, which could mean a clawback later. This is a classic way to juice short-term returns but can impact future payouts. The fund's leverage ratio, which shows how much debt they're using compared to their equity, is 1.32x. This means for every dollar of equity they have, they're using 1.32 cents of debt. For a credit fund, this isn't necessarily alarming, as leverage is often part of their strategy to boost returns, but it's definitely something to keep an eye on. Let's dive into their total net returns as of June 30th. For Class I shares, the 1 month return was a solid 0.64% year to date. They're up 4.44%, and since inception, they've returned 5.27%. Now it gets a bit more complex with Class D shares. The returns are split based on whether there was an upfront placement fee. Class D shares with the maximum upfront fee of 1.5% actually saw a negative return that month of 0.86% and are only up 1.22% year to date and since inception. This shows how those upfront fees can really eat into early returns. The Class D shares without that fee performed much better with a 0.62% and are only up 1.22% year to date and since inception. This highlights the importance of understanding what fees are attached to different share classes. Now, for the core of what this fund does, its investments. As of June 30th, they had about $658 million invested across 156 different companies. Pretty diversified. Interestingly, 100% of their debt investments at fair value were floating rate loans. This means the interest rates on these loans will adjust with market rates. So if interest rates go up, their income from these loans goes up too, and vice versa. They mostly hold first lien senior secured loans, which are the safest kind of loans a company can offer, meaning if the company goes bust, these lenders get paid back first after some basic costs. They had a tiny bit in second lien loans and warrants, but it was all first lien dominance. Looking at the industries they invest in, the top sector is healthcare providers and services at 12.2% of their portfolio. They're also heavily invested in professional services and software, both at 11.2%. This shows a leaning towards service-based and technology-oriented businesses. Nothing too surprising there. And the largest single company they have invested in is Irving Parent Corp, representing 2.5% of their portfolio. The top 10 issuers make up a fairly small portion of the overall pie, with the largest being just 2.5% and the 10th largest at 1.6%. This indicates a pretty well diversified portfolio company by company. Geographically, almost all their investments, 97.1%, are in the United States, with a small presence in Europe and Canada. This makes sense given they are a US-based fund. For their direct lending portfolio, the weighted average spread above the benchmark interest rate is 5.65%. This is essentially the premium they earn for taking on the credit risk. The average EBITDA, or earnings before interest, taxes, depreciation, and amortization for these companies is about $24.2 million. This is a measure of their profitability before accounting for certain non-cash expenses and financing costs. The average loan-to-value ratio, or LTV, is 36.7%. This tells us how much debt a company has relative to its overall value. A lower LTV generally means a less risky investment, and their average leverage ratio for these companies is 3.4x, meaning on average these companies have about 3.4 times more debt than their EBITDA. Again, this is a key metric to watch for credit funds. They also do asset-based lending, or ABL. This is when loans are secured by specific assets like inventory or accounts receivable. As of June 30th, ABL investments represented 4.7% of their total investments. Finally, let's look at the status of their offerings. They are continuously offering up to $5 billion in common shares. As of this filing, they've issued 4,205 Class D shares in their public offering for about $100,000. This is a tiny fraction of their total offering capacity. But the big story here is their private offering. They've sold a massive 12,465,359 Class I shares for a whopping $303.7 million both offerings. It has issued over 12.4 million shares for over 330 offering 7 million both offerings. So what's the story here? First, Eagle Private Credit Fund is actively growing and raising significant capital, primarily through its private offering channels. Their portfolio is heavily weighted towards safe first lien senior secured loans with floating rates, which could be a double-edged sword in this interest rate environment. They're also quite diversified across industries but very concentrated geographically in the US. The distribution rates look decent, but investors need to be keenly aware of how those distributions are funded and the potential for waivers or reimbursements. The Class D shares with upfront fees definitely underperform those without them highlighting fee sensitivity for investors. Their leverage is moderate for their industry and the overall health of their underlying loans, as indicated by the LTV and leverage ratios seen within expected ranges for private credit. It's a fund that's executing its strategy, but like all investments, it comes with its own set of risks and nuances that investors must understand its strategy, but like all investments, it comes with its own set of risks and nuances that investors must understand. What do you guys think about these figures? Are you impressed by their capital raise or concerned about the distribution funding? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more deep dives like this. And don't forget to join our Discord community linked in the description below for more real-time discussions and to connect with other finance enthusiasts. Thanks for watching, and I'll see you in the next one.